With the month of November now in the books, in this week's video, we'll address the question, are monthly charts starting to show some cracks? Since it's now been 468 calendar days since we covered the bullish signal that had only occurred 10 other times in the past 35 years, market fractals tell us the bullish developments that we've covered over the past 468 calendar days should have made a logical progression from short-term charts to intermediate-term charts to long-term charts. The market started to turn in a bullish manner in February of 2016, and the signals that we saw during this period were confirmed in November, December of last year, for the most part after the US election. Therefore, in this video, we'll be looking at another collection of long-term charts to see if they align with the story that was being told by the short-term charts and the intermediate-term charts. This long-term monthly chart of the Nasdaq Composite Index as of November 30th, 2017 seems to align with the weight of the evidence that tells us to keep an open mind about much better than expected outcomes over the next 5 to 20 years. The longer a market goes sideways, this is consolidation, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. In this case, we got a bullish breakout after sideways consolidation, and the type of market that followed this type of market, this is quite a bit different than this. In the present day, this will most likely be quite a bit different than what we will see over the next 5 to 20 years. And that's a probabilistic statement based on the facts that we have in front of us today. If this breakout fails, then we'll adjust that probabilistic statement. After this bullish breakout here, the Nasdaq Composite Index, we didn't need to own the latest and greatest technology stock. If we just held the index, the entire diversified index, it gained 892% from point A to point B, and that rally lasted 9 years. Obviously, this consolidation is much, much longer than this period of consolidation here. So we can compare apples to apples with dividend and coupon payments. This is technology stocks. We're using the Fidelity Select Technology Fund relative to WHOSX, which is a long-term treasury mutual fund, similar to TLT in today's ETF world. We have a long period of consolidation here. This is indecisive behavior in the market. Fractals tell us that consolidation can last a few minutes, a few days, a few weeks, a few months, or a few years. We currently have a bullish breakout, and we have the 50-month moving average turning up as price breaks out of the box. This is a discernible downtrend here. We can see it. And then we have behavior that looks very, very similar to what could be an inverse head and shoulders pattern. These are somewhat of the early adopters here in the left shoulder. This is when the masses believe that something's wrong, and typically your right shoulder here allows you to shake out the last batch of skeptical investors. And if you know your chart patterns, you know that when the right shoulder is much shallower than the left shoulder, that also tends to lean in the bullish direction. If, and we emphasize the term if, this type of pattern plays out over the next few years, the back of the envelope projection would be this purple line here, and it literally would go off the chart. Now we're looking at a Fidelity mutual fund that tracks industrial stocks relative to that same treasury-based mutual fund, WHOSX, basically looking at another stock versus bond chart. The ratio runs into resistance in the year 2000 comes back up to the same basic area in 2007 and fails, and price was also rejected the same exact level in 2013. And in the present day, the ratio broke out in late 2016. Here's a retest of the breakout, and now we've gone on as of November 29th, 2017 to make a higher high. Right now, this looks like a successful bullish breakout in favor of industrial stocks relative to bonds. The longer the breakout holds, the more meaningful it becomes. This is an early stage breakout look from a very long-term period of consolidation. And we have that same type of psychology shakeout pattern with a left shoulder look here, a head look here, and a right shoulder look here. And once again, the projection, back of the envelope projection, from a probability perspective, would take this ratio off the chart. It's important to keep in mind the charts that we're reviewing here are long-term, big picture, confirmation type charts, rather than shorter-term charts that we would use for timing and allocation purposes. There's nothing on the chart of the NYSE Composite Index as of November 30th, 2017. It's a monthly chart at month end. Nothing here contradicts the information that we've covered over the past 468 calendar days. We have long-term consolidation and indecisiveness, a bullish breakout, a retest, and now a higher high. You can make an argument that this point here is very, very similar to this point here. And after this bullish breakout and retest, the average stock from this point here rallied for an additional 19 years. And over that 19-year period, we didn't need to own anything fancy. The average stock gained 997% from point A to point B. Once again, telling us to keep an open mind about much better than expected outcomes over the next 5 to 20 years. And this expression also jumps off the page. A move followed by a sideways range often precedes another move. This would be the second move here, of almost equal extent in the same direction as the original move, telling us that we could copy this line here and paste it here. If the expression held, we would see another move of almost equal extent in the same direction as the original move. This is the original move. We're using mutual funds here because they allow us to go back further. We don't have ETFs in 1990 here, but we did have the Vanguard Index Trust 500. This is basically an S&P 500 index fund relative to a diversified investment grade bond fund. The longer a market goes sideways, the bigger the move we can expect to get. And market fractals tell us that this consolidation that lasted from roughly 1990 to 1995 is very, very similar to the consolidation that lasted from the late 1990s until we saw a confirmed bullish breakout in calendar year 2016. This period of consolidation is much, much longer than this period of consolidation. And as of November 29th, 2017, this chart, this stock-bond ratio, aligns with all of the evidence that we've covered over the past 468 calendar days. Since home building ETFs weren't around in 1998, we'll look at Lennar, a home builder with the ticker symbol LEN. Price was inside of this orange box. In 1998, it went to the top of the box and was rejected. It went to the bottom of the box in 2009. Now we're back to the top of the box, and it looks like we have a successful bullish breakout. This monthly chart at month end is clearly above this level here. The longer the breakout holds, the more meaningful it becomes. As we're breaking out, we have somewhat of a flattish look here in the moving average, and now it looks like it's trying to turn back up in a bullish manner. We also have a shorter period of consolidation here that dates back to late 2014. So we have a bullish breakout from a shorter term multiple year consolidation box that's basically occurring simultaneously with the breakout from the very long term consolidation box shown here. The slope of the 50-month moving average here tells us that home builders, or at least in the case of NVR, this is a very indecisive, trendless type look here. We were rejected here, went down near the bottom of the box, came up here, had a false breakout, came back down, broke out again, and now it appears that this breakout is holding. This breakout occurred in early calendar year 2014, and we've remained above the orange box, and the slope of the 50-month moving average is starting to pick up. The slope of this line here is quite a bit more favorable than the slope here. We do still have some small exposure to a small cap growth ETF. If we were going to add to our small cap exposure, we would like to see a little bit more from this ratio here. This is IWM in the ETF world relative to SPY. It still appears to be trading in this long-term downward sloping trend channel here with price below the 50-month moving average. If the ratio can get to this point here and remain above this line, that would improve the probability of small caps outperforming large caps. We'd also like to see eventually the 50-month moving average turn back up in a bullish manner. Remember, we're looking at relative performance here. So the look of this chart doesn't mean we're down on small caps. It just says from a long-term perspective, we like large caps better than small caps. In the present-day environment, the odds are extremely high, if the charts remain as they are today, that both small caps and large caps will make money. And there still are encouraging things in the financial space. This is XLF relative to SPY. You can see this acted as resistance here, here, and here. This appears to be a bullish breakout. There's step one of a trend change. Now we've made a higher low relative to this low. If we can print a higher high here in the ratio, the odds of financials outperforming the S&P 500 for the next few years will increase. If that can happen, we would be open to adding to our position in banks, which right now is an extremely small position. The extremely small position that we have on the books from a percentage basis or a percent of our portfolios allows us to keep an eye on it and allows us to have an open mind. We're not rooting for or against financials relative to SPY. We just want to make sure that we get it right. If financials underperform, we will not add to our existing position. But if financials start to outperform and this ratio can get up here, and the shorter term and intermediate term charts can improve as well, then we'd be happy to add to our financial stake. The charts that we just looked at, those are forest charts. How do the trees look in early December 2017? And we know from past videos, this is the type of transition and rollover look that we want to avoid using our generic and for illustrative purposes only simple moving averages. How did the exact same moving averages look on Thursday, November 30th? The answer, as you might imagine, is much, much better. The present day still looks more like one of these sustainable bullish trends, and that's a probabilistic statement based on the facts that we have in hand. This chart is as of November 30th at 2:58 p.m. You might be saying, but wait, the hard data might have been impacted by the news that came out on December 1st. This is a Market Watch headline here dated December 1st. It's 12:28 p.m. If we look at the exact same moving averages on Friday afternoon, December 1st? Were they altered by this story? The answer is no. They basically look identical to the look we saw the day before. It's the same moving averages dated December 1st, 2017 at 2:04 p.m. Eastern Time. And since new headlines are constantly flashing across the ticker, it's important for us to always keep in mind in this type of environment, given the facts that we have in hand, our goal is to navigate between a point A and a point year that could potentially be several years down the road. In calendar year 2017, if we had focused exclusively on the headlines, May 31st, 2017, January 2017, February 2017, complacent investors should heed political risks. December 2016, almost a year ago, worries over complacency as VIX slips to yearly low. These type of headlines that were not particularly helpful in a year that the stock market has done well remind us the difference between information and utility. I could wake up at 4 o'clock every morning and read the Wall Street Journal cover to cover. I could read every single story that comes across the Bloomberg terminal. And if I did that every day, I would probably be incredibly confused, stressed out, and overloaded with information. How do we use this type of information? If someone sent you a link to this story, how would you use it? How would you turn this story into something you can use to make a rational decision? If someone forwarded you links to all of these stories during the year, how would you use them? What are you supposed to do with them? This is information. Utility means we can use information in a way that can help us make rational decisions and potentially profitable decisions. This type of information is already baked into the charts. Any piece of information that we can think of about the Fed, about interest rates, about valuations, about geopolitics, about politics, about the VIX, all of it has been considered by the market on multiple time frames. The market is constantly going through what-if type scenarios. And if headlines like these headlines here, or any news story for that matter, become meaningful, then it will be reflected in the hard data. When we're looking at the hard data objectively with that flexible, unbiased, and open mind, we are already keeping track of all of this because the market is taking it all into consideration and all of it is reflected in the charts. We said you could ask a question, how do I use this? What do I do with it? If we were to ask the same question about the market model or a set of prudent charts that you could use to make decisions or prudent pieces of hard data, the answer would be simple. We know exactly how to use the hard data. We know exactly what we're going to do and when we're going to do it. That is absolutely impossible to come up with that if you woke up at 4 o'clock in the morning and read the Wall Street Journal cover to cover every day. That's information. We have to find a way to take all of this information, an overwhelming amount of information, and get it into a rational and usable and scalable form. If any of this was relevant during 2017, it would have been reflected in the charts that we've been covering in these weekly videos. At some point, there is something that will matter. And when that occurs, the charts, the moving averages, and the hard data tracked on multiple time frames, it won't look like this. If this story heads down a road where it eventually matters, the charts won't look like this. They'll slowly start to morph into a look like this or this. And the only way that we can properly manage going forward is to maintain that flexible, unbiased, and open mind. And take the attitude, if someone says, what's going to happen tomorrow? The proper answer is we have absolutely, positively no idea, but we're confident that we can get up tomorrow and look at the hard data and make rational and prudent decisions, calculated decisions based on the facts that we have in hand, not fear of what might happen. Thus, we don't want to get overly preoccupied with this type of information. We don't want to try to read every article that's bullish and every article that's bearish. And for that matter, we don't want to look at every single chart and every single indicator. That's information overload. Utility is when we decide what's valuable and how we're going to use it and when we're going to use it. So our focus shouldn't be here. In this type of environment, it should be on our objective, which is to try to navigate from a point A to a point B that could be several years down the road. And as we've covered in past videos, we know with 100% certainty, without a shadow of a doubt, even if good things happen, for the next 19 years, there is going to be normal and to be expected volatility between the point A and the point B. Volatility is not the enemy. Instead of continually adding additional, we're not really sure how we can use this information to our arsenal, we're better off focusing on utility. One of the incredibly important things about utility is we have to have realistic expectations about how markets operate in the real world between a point A and a point B. For example, the NASDAQ gained 892% over this 9-year period. Does that mean that the NASDAQ outperformed the S&P 500 every day, every week, every quarter, or every year? The answer is absolutely positively no. If we take the same chart and look at the NASDAQ relative to the S&P 500, between the same point A and point B, we get normal and 100% to be expected counter trend moves within the context of an ongoing and established bullish trend. If we don't have realistic expectations about our positions, then it's going to be very, very difficult to manage them prudently. Thus, one of the common missteps is expecting all of your positions to outperform 100% of the time. As we noted, all forms of leadership, ETFs, indices, sectors, regions of the globe, asset classes, all of them, when they're in the context of an outperforming type trend, similar to this trend here, they all have normal counter trend moves. How do we determine what's a normal move and what's an abnormal move? We use the weight of the evidence. There's not a binary answer to that. As time goes on, the data will help us fan our pie chart and decide whether we want to decrease exposure to tech or increase exposure to tech. And if you were able to navigate from this point A to this point B, you wouldn't be doing it with a fixed allocation to tech. There would be times where your allocation would be higher, and there would be some periods where your allocation prudently, based on the facts in hand, would be lower. Or even in some cases, it might drop to zero. Like any other decision we make, those decisions are made based on facts, not predictions or fear of what might happen. Thus, in the present day, in December 2017 and in Q1 of next year, it's not realistic to expect technology stocks to lead every day, every week, every month, every quarter. And the best way for us to understand what realistic expectations are in the markets in the real world is not getting up at 4 o'clock in the morning every day and reading every article we can get our hands on. We're much better off from a utility perspective studying historical charts. As we mentioned in past videos, most master chess players get really, really good by studying setups on a board. It gives them realistic expectations about what they can expect during the beginning, middle stages, and latter stages of a chess match. Now, here's another example. If we're expecting all of our positions to outperform 100% of the time, during this clear downtrend where small caps are underperforming large caps from point A to point B, we could be over trading our account by trying to flip back and forth between small caps and large caps. If small caps are going to lead for the next few years, absolutely positively could happen, the data on multiple time frames eventually needs to improve. That may or may not happen. We really don't have a preference one way or another. We just make decisions based on what's in front of us. This is what's in front of us as of November 30th, 2017. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.